All right. Mutual funds, index funds, or single stocks? That's the question today. And we got a special guest. Campbell Davenport's joining us from Faith Fueled Sales. He is actually the one who gave us the idea for this conversation this morning, or this, today. So we wanted to invite him to be a part of it. So I'm just going to throw it out there. Let's start. Somebody give us the kind of elementary school definition of those three different things.
Oh gosh. I can't really speak to mutual funds, to be completely transparent. They're like a conglomerate of a bunch of different stuff that's managed by somebody else who, kind of makes sure everything stays on track. Obviously, indexes, I can speak to that. By the way, nothing that we say is financial advice. So let's go ahead and get that out on the table. Index funds, obviously, the S&P, NASDAQ, Dow, things like that, the big ones that hold a bunch of companies. And then single stocks are single stocks. Should be pretty self-explanatory. And then, what's the question here? The question is, what's better? There is seemingly this trend that's coming out that's like, hey, let's invest in single stocks and, maybe even have a portfolio of just a small amount of stocks. That seems to be kind of catching a little bit of ground. So the answer is, what's better? What's right?
I think the biggest thing, let's get some more clarity before we talk about what's better. Obviously, I think most people probably know what the difference in a single stock and a mutual fund is, or an index fund. But I think there can be a lot of ambiguity between what's the difference in a mutual fund and an index fund. And you can even tack on like ETFs, exchange traded funds as well. Campbell, can you just kind of break down what the difference in something like an index, a mutual, or an ETF is?
Yeah. I'll start with mutual and index, I guess. Mutual funds are actively managed funds. And again, disclaimer, I'm not a financial expert, just going to have some practical experience, but mutual funds would be actively managed funds. So somebody's actually going to go in and make adjustments based on their experience. You're going to buy and sell funds in that portfolio or specific positions in that portfolio over time to try to beat the market. An index fund most of the time is just trying to track the market or replicate a broader kind of market of companies and how they're performing. So indexes are more passive. You're going to pay lower management fees because of that passivity there. And then mutual funds would be more active. And so you have a higher expense ratio on those.
What's your personal, just because you're the guest here, what's your kind of preference? If we can jump into that now, or can we jump into that, Dylan? Okay, cool. What's your preference? Like, maybe here's my question: what do you do? That's the question to ask.
Yeah, most of my investment portfolio is in just broad market index funds. I do that for a couple of reasons. I think it's one less just brain power on my end. Like it is easy to do. I'm not having to think about it. I'm honestly really not optimizing for performance in the short term either. I'm betting on long-term appreciation and compounding in the market. It is easy. It is simple. I know I'm going to get some appreciation, and I know that I'm not going to feel hosed by expense ratios. So that is my personal preference. But I know there are specific mutual funds that will outperform other things, and I'm sure you guys have some other ideas too.
Yeah, I take I am on the flip side of that. I have adopted just kind of the mutual fund route. And in my mind, at least the fact that it's being actively managed hopefully means that it's going to outweigh the cost of the, expense ratio. And I have very strict guidelines for what mutual funds I will invest in. It's usually like, I want to see a track record of 5 straight years of outperforming, the associated index with it, that sort of thing. So trying to build in some security there. But yeah, that's my kind of take on it. How can someone assess kind of their personal financial goals, where they're at, to decide if, when it's time for investing, if mutual fund, index, or single stocks aligns best with their need?
That's good. Josh, you want to take that or?
Yeah, how can someone, I was just kind of going to repeat the question to myself here, just so I can understand it. How can someone assess their financial goals to decide what is better, mutual funds, stocks, or single stocks, or stock indexes versus single stocks? I mean, gosh, I hate sounding like a broken record, Dylan, but but it's the first thing that comes to mind. It, in so many ways, it comes down to like your personality, you know,
Mhm.
and your goals, of course, and it's nuanced, as we always say every single time. And and you know, I would even add in there. You would also want to add in like what's your risk portfolio or risk profile, not portfolio, risk profile like, and then how much extra capital do you have to be able to invest in any one of these, and how much time do you have to be able to devote to these on a regular basis or not regular basis? Because in my mind, mutual funds are better if you're like more of a set it and forget it kind of approach. Stock indexes might be kind of more in the middle. And then this is very much overgeneralizing, I think, but single stocks would be more better if you're going to like actively. And you could even make the argument that single stocks is maybe not even like long-term investing. Maybe it is, but it's maybe even, you might even be approaching a couple of different trading styles, like either position trading or maybe even swing trading would be even shorter term than that, with like a 3 to 6 month horizon. So it kind of just depends on, you know, your interest level too and what your goals are. So there's so many different things. I don't know. I'm rambling at this point, but that's my initial thoughts.
Yeah, I feel very similarly. I think um I almost think about myself like as an investment. Like, hey, I only have so much time. I only have so much brain power. I only have so much energy. So how am I going to invest that? And then I have my own kind of tolerances there. Um, I mean, I know the two of you guys. So we're all in sales, which means we got to be fully present when we're there. And that's the reason that I personally opt for indexes, because I want a very uh, relatively low risk, but some reward on the back end investment vehicle that I don't have to really think about,
Mm-hmm.
that I can just automate, and that frees me up mentally to go out and sell at a really high level and help other people do the same. So I kind of I'm looking at, you know, risk and energy management and brain cell management, all of those things.
Sure.
And so that's that, you know, that kind of went into my decision there.
Yeah, same here. I mean, I maybe log into my brokerage account on the high end once a week, you know, on the high end, just to kind of see the state of the market as a whole, not to check the actual performance of each individual fund or anything. And I probably maybe once a quarter will go in and actually start diving into the performance of my individual funds, because I just would prefer not to be thinking about that on a day. And at least this is my interpretation of somebody that relies on single stocks as their primary, you know, means of investing for retirement or whatever, you know, that you are having to think about it more often, I guess, is my thought. Having to have a little bit more of an active control over that. And maybe I'm wrong. Speak into that. I don't know.
Yeah, I'll touch on that because both of you guys had mentioned the Campbell. You had said you're kind of more interested in index funds. That's great. Dylan, you're more interested in mutual funds. That's great. See, I'm personally more interested in single stocks. I love them. I think they're fun. I think they're exciting, you know? And at the very same time, like I have money in a 401k that I I I think I look at it less than once a week. I mean, it's probably once a once every 2 weeks, once every month, some 2 to 4 weeks, something like that. But then at the very same time, like I do have money in like I have my own, you know, single stock portfolio, so to speak, where I literally will check the market multiple times a day from my phone. And it's like an addiction, you know, you could call it that if you really want to. Whatever,
Yeah.
we all have something, right? We all have our vices. But I really like that. And then there's IRAs as well, where that is more of like a set it and forget it kind of thing on top of the single stocks and on top of the 401k. Um, but the single stocks that I invest in, that's more like that's not long-term kind of stuff, I guess. Well, not I guess, not at all, you know. I'd like to hold it for like a year, you know, to avoid like long-term capital gains kind of thing. Not a tax advisor either, so speak with your
I
CPA.
think that they're like, we're almost hitting into what you touched on earlier, which is like, is this investing, or is this active trading actually like a part of how I'm making income actively? And that's where I think single stocks, depending upon your level of proficiency and knowledge, there's a lot of different ways to interpret, you know, single stocks. Are they investments? Are they, you know, you analyzing the market, trying to take advantage of something that you see is undervalued, that kind of deal?
Yeah.
Let me ask it
I
this
think it
way.
comes I was just
Go
gonna say
ahead. Go
before
ahead.
you asked that, I was gonna say, I think it comes down to like I mean genuinely, like how much interest do you have in financial markets? Like if you geek out and nerd out over looking at candle charts like I do, hey, you know, go for it. And if you don't and you want to focus on other things, that's totally cool. Because like I make I have a halfway decent income just from trading stocks, you know. But I like it. I don't know why. It's weird, you know, but everybody's got their thing. And that doesn't make me any better or worse than anybody else. It's just I just know myself and I like it.
So
So anyways,
let's most people, right? Most people, when I, you know, I'm just making a presumption about Americans, I guess. Most Americans probably don't have, you know, the knowledge, the experience that each of us have with investing. That's just, again, I'm making a generalization, but I think we know that to be true. Like if close to 70% of people are living paycheck to paycheck, they're probably not thinking about investing. So what would you say to the person? And I'm not asking for like a general answer. I kind of want to just hear how each of us would individually answer this question based on our experience. Like, you know, one of your closest friends comes to you and says, "Hey man, I've never invested a day in my life. I know you know a little bit about investing. I want to I'm 30 I'm 35 years old and I want to start planning for retirement. I've never done that before. What do I need to do?"
it's a good question. They've never invested.
And this is specifically retirement.
Sorry, let's just say I want to start investing in general. Let's just say that.
Okay.
And they haven't like no employer match or anything like that in the past
No,
for 401k?
nothing.
Nothing.
No,
Just they have nothing safe for retirement. I'd
they've
say,
done nothing.
We
I'm
get no
sorry,
guide rails
man.
with this, Josh. We get no guide rails.
I mean,
Okay.
this is a lot of people's story.
Yeah.
Yeah. I'd say, well, do you have a house yet?
Yeah, sure, they are a homeowner.
Okay. Okay. So we have some assets here that we're
Yeah.
working with.
Don't be nitpicky, just answer the question. Yeah.
I no. Okay. I mean, and they want to do it on their own, or I'd start asking them personality questions. That's what I would start doing, and I'd say,
Yes.
do you want to how much time do you want to give to this on a weekly basis or daily basis? That's where I would start with that. Depending on the answer there is how I would take it. If they're like, you know, I kind of want to check it once a week, I'd be like, all right, sweet. Like you can probably invest in some indexes and that would be fine. Or they're like, you know, I really feel like I might have an interest in this. I'd like to, you know, give maybe 1 or 2 hours a day. I'm like, sweet. Well, that's a whole nother conversation. So really, again, comes down to portfolio and knowing yourself. What do you think, Dylan? What would you say?
I would start with what's your goal? I mean, determine your goal. Like why do you want to start investing? Like
Mm-hmm.
that would be my, you know, and I would venture to guess a person in that situation's probably going to say something like, "Hey, I just want to be able to retire, and have money when I retire. I think that's I don't think the average person is interested in like day trading, and stuff. Um, you're going to have people that are for sure, and so
Mhm.
I'm going to go the route of just educating them on like the basic retirement accounts. Like if employer match, if they've never had a RO, a 401k or anything like that before, like, hey, here's what a Roth IRA is. And, knowing that you're starting out, you're probably not putting more than $7,000 a year at this anyways, because that's the annual contribution limit for a Roth IRA. So let's start with a Roth IRA and let's start investing in some, mutual or index funds. I don't care, whatever, but let's get in a Roth IRA, and start investing in something. That's going to be my, gut. And one of the things I'm passionate about is helping people see how easy that really is,
Yeah.
to invest in a Roth IRA. Like, if you just want to hire somebody to do that for you, you certainly can't, but you don't have to. Like, it really is something
Mhm.
that you can open up a Roth IRA just as easy as you can open up a checking account, and like with a little bit of education on how to like press buy and know what to
Mhm.
buy. Yeah. Once you
It
know what to buy,
I
yeah, it's
I
easy.
I was just gonna say I appreciate you saying that, Dylan, because I didn't want to get too ethereal. Because again, I nerd out on this kind of stuff, so I'll shut up for a lot more of this. But I appreciate you saying that it is really very simple to open up an account. I mean, like you said, as easy as opening a checking account, it really is. Go ahead,
Yeah.
Campbell. Let's hear from you.
Yeah, no, it's good. All this is good. It makes me think like practically about my life and me and my wife's experience. I know that coming up through college, like I had an interest in financial markets. I loved real estate, so I like debt markets and stuff too, and so was constantly thinking about those things. So I had a definitely a different approach than she did. But honestly, what got her kind of into investing, I would guess, or what made her a little bit more knowledgeable was, man, being able to open a Robinhood account and see very simple data and track like, hey, how is my stuff performing? And I think what I was going to say is, in true Money Mavs fashion, it's not one or the other. Like you can have money in a 401k, money in
Mhm.
indexes, take some bets on some mutual funds, or do your research there. And also pick some single stocks that, man, you're optimistic about or have some knowledge of. Or honestly, if it's disposable income, you just want to see how they perform and you want to use that as basically you're paying to learn. So I think there's a lot of I think there's a lot of different ways to take that. I think if I were to encounter or wander into a conversation where somebody's like, I have no clue on investing, but I would like to start figuring that out. I would be asking kind of similar questions to what Dylan's saying about their goals, but I think I would probably, man, in 99% of scenarios, start with, hey, are you employed? What kind of match are you getting? Are you getting a match? Because regardless of what your preferences are, like it's hard to beat free money.
Mhm.
Um, if you're planning on putting money in the market anyway. So
And
I
we've
would
all got
start
that.
there. Yeah, yeah. So I would start there, and then build on, what are your interests, what's your risk tolerance, all of those things. How much time do you have?
Something I would
Yeah.
jump in and say though is I've seen this happen, to myself, but also to numerous other people with employer matched contributions and stuff. Like, you still have to know what that money is being invested in. You still have to
Mhm.
know what all that account mean. Like, don't just assume because there's money being put in an account somewhere that it's like being invested for your best interest.
Right.
For instance, I've heard stories of people that contributed and had, their employee match for years, but they themselves never actually went in and selected an investment plan. So the money never got invested in anything and it just sat there and didn't actually grow. But then I've also, from my experience, seen like in my current job, the first about 6 months, I didn't do a good enough job, like looking into what that money was going into. And about 15% of the money was just going into bonds, which was something that I didn't earning 2% a year. And at my stage of life was like, there's no reason that I should be investing. And so
Mm-hmm.
I had to shift
It's
around some
prudent.
of the investments. And so don't think that just because like, oh, my employer is giving me, 4% or whatever, and it's being put in this account, know where that money is going.
Right. Yeah. Yeah. And that brings up a point. Like typically your employer, if they do some kind of 401k match, they'll have like a partnership with some kind of financial firm where they can help you with a lot of that stuff. So that's something really helpful. I want to ask this question because it's a great one. For someone looking to build long-term wealth, how do you recommend, either of you, recommend balancing the stability of index funds with the potential growth of single stocks? Now, what can often happen is you're like, oh man, you're looking at a financial market or whatever, and you just dump it into the S&P, okay, a SPY ETF or whatever, and then you see these individual stocks ripping, you know, 20, 30, and these are not like, small cap stocks or anything. They're like
Right.
actual legitimate companies, and they're ripping 20 or 30 or 40 or 50% inside of a few months. And you're like, well, what the heck? Like all I did was put it into the S&P 500. Why didn't I just do that? How do you
I'll speak to
how do
like
you balance that?
what my plan is. And this is my plan at 25 years old. Surely it's going to change at some point. Um,
Hmm.
I'm maxing out my employer match in my 401k and keeping that,
Okay.
invested in the funds that it's invested in, right? Secondly, I'm working to max out the Roth IRA, which is going to stay for me, I picked hand selected 7 mutual funds, all that money. And then after I max out my employer match and my Roth IRA, my plan is to then pivot to individual brokerage account and start investing in single stocks. That's that's going to be my personal balance. Um, I'm just kind of, and I don't know that there's a real science or philosophy behind it. I just know, as we've talked about, there is value in all three, and there is value in diversification. And that's going to be my approach.
Yeah. Mine is probably similar. I think that right now the plan is to max out the match and then max out Roth. Here's where I think ours differ a little bit, Dylan, is I have a real interest in like private equity and like investing in businesses and like investing in other opportunities. So um, I will be putting money into like an IRA, but I probably plan to borrow against that,
Hmm.
or even just use that in the short term. That might go into not necessarily an IRA, but in an active kind of brokerage account that I dump in some indexes, or have that in like short term bonds so that I can be liquid there. I'm thinking more about, hey, can I get a little bit of appreciation by this cash not just sitting, under a mattress? Can this go into like a high yield savings or something like that? So
Hmm.
that when I want to deploy that into a business opportunity, or invest in another opportunity that comes up, I have that capital there, and that's I'm you said well strategy long term. So I think it is important to note there. Hey, there are more asset classes and ways to build wealth outside of just stocks and mutual funds.
Sure.
Like you said earlier, kind of Dylan, in mutual funds, bonds and stuff like that get looped in there. Treasury bills, stuff like that. So can get included in some of those funds. So yeah, that would be that's what I'm doing. I don't know if it's the right thing to do, but that's my approach right now.
I want to ask this. This just has me thinking. Um, at every level, investing, whether it's one of these three options, the idea of investing comes with like a lot of emotions for a lot of people.
Hmm.
Um, there's highs, lows, there's pitfalls. What has been your journey handling like the emotions of investing, from when you like first learned about investing to now, how do you bring emotion and feeling into weighing that into your decisions? Does that make sense? There's a lot of fear around investing is kind of what I should have said. Like there's a lot of emotional fear in our kind of culture and world. And so how do we fight that? How do we balance that?
When you say investing, because there is a difference between investing and trading. There's a massive difference between those two things.
For sure.
Investing is like very much long term, set it and forget it kind of thing. Trading is anywhere from 2 minutes up to or less, up to 12 months could be considered a trade. So which are you talking about here, just for clarity's sake?
Talk about both. You do some day
Okay.
trading, so talk about your
I do.
experience with that, and then Campbell can, I don't know, whatever.
Campbell made the comment. What did you say? Pay for your education. I've done that, which was not a fun experience, to say the very least. Lost a good amount of money, but it served me well now. So I did pay for the education. And like I've learned a skill that I feel like I can employ. But again, not and again, I don't want to get too much into my experience. How do you deal with the emotional side of it? You're not emotional about it, with trading in particular, or investing for that matter. It applies to both. It really does apply to both. Like, hey, if you're investing for the long term, set and forget it kind of thing. Hey, if the market goes down 20%, whatever, deal with it. It's the exact same thing with trading, but it's very much on a much more acute level. And when you're watching things go up and down, and you're watching, I mean, you're not supposed to watch this, but when you're watching your P&L go up and down, there are emotions that come into play, and it really is like a muscle that you have to train yourself, and it takes time, and it doesn't come without paying for it. And again, that's more on the short-term trading side of things. And again, I don't want to get too much into that. But really what it comes down to is you have to divorce yourself from the emotions entirely, which is hard, which is very hard. And you have to be disciplined about it, which is something we talk about every single week in our conversations. It's like anything financial you have to be disciplined about,
Or put, if you want to ride the emotional roller coaster, like do it with disposable income. If you want to pick some single stocks or you want to trade, man, set aside, $1,000 or $2,000, like whatever amount you need to feel satisfied and be able to get your hands dirty, and have that kind of experience. But don't sacrifice your long-term wealth building strategy for short-term success and for that emotional high of making a big trade or picking a stock and that panning out, because it can swing really quickly in the opposite
bro,
direction.
It's so fun.
Yeah,
it's
it
so
can swing
sick,
really
dude.
quickly in the opposite direction too. So, I think
Yeah.
and I've done that a lot too. I've picked some single stocks, but I've also, the bulk of my stock portfolio is in indexes, and that's what it is. I was going to say this earlier about indexes too, because you mentioned some large cap stuff, Josh and Dylan. Like in indexes, you get pieces of those companies. You just don't have the same,
exposure.
Exposure. That's a good word. You don't have the same exposure to those big companies that are seeing those outsized returns, so or beating the market. So, anyway, that was my contribution there.
Yeah, and I do wanna hit on the emotional aspect of the other side of things with just even the idea of investing in the market in general. Like there are people in the world that are in our country, maybe even that are listening, that are so fearful of just even that word investing. They're like that the
Do
idea
you
of
know people? I'm curious. Do you know people like that?
like there's not somebody that like, oh, one of my closest friends is like this, but
Sure.
it's like I spend a lot of time in Facebook groups, YouTube videos, comments. Like there are people that you can read, Facebook comments, YouTube videos, but they're like, oh my gosh, like I'm gonna, pull out my entire 401k because I think we're about to enter a recession, or
Yeah,
or I'm gonna cash out my, and then there are people that legitimately will say like, I'm never going to put my money in the stock market because it's too volatile. Like there are people that have that little trust for, and ultimately we know that's just an ignorance of reality. Um, but like, I mean, what do you say to that?
I mean, Campbell, what would you say to that?
I mean, our number is scary. Our number is scary. Like, is the number 3 scary? You know, like I would just go back to the math. Like, I would go back to the math and I would evaluate like your situation. Like, hey, just if the emotional side of it like scares you, just look at the numbers. Just look at the numbers and trust the numbers. It's just data. Look at it as data. But you know, if you are up against some kind of cap, like you're about to withdraw and enter into retirement, like consider that environment a little bit and operate based on your risk. And in all honesty, if you're having those fears, you probably need to go talk to a financial advisor or somebody that is a little bit more knowledgeable of walking a lot of people through those situations and help them, you know, get the confidence from them that you are lacking if you're really fearful there.
Yeah, I'd say to somebody in that situation, like, I mean, again, you have to divorce yourself from the emotions. Again, it's a very hard thing to do.
With money in
Just on
general, I
a
think.
Yeah, with money in general, which I I wouldn't even say hard. I would even say it's almost impossible, to be completely frank, to entirely divorce, because we're emotional people. You can't
For sure.
like, let's address the reality. We're emotional. We all are. We're all going to experience emotions on one level or another. We want to try and reduce that to the best of our ability when it comes to emotional decisions, especially when it comes to like, oh my gosh, the market's gonna crash. Like, see, my perspective on those kind of things is like tight. It's a buying opportunity, and so it's not like I put 100% of my available assets into the market because I need, regular spending money and everything. Um, but like I keep a good chunk of cash in case there's like a big dip and I'm like, tight, like let's buy more, you know? So that's kind of my perspective as opposed to a fear-based kind of perspective where it's like, I don't want to because the market's going to crash. Well, guess what? The market is going to recover too, you know?
Yeah, yeah. And I think that's like an output kind of focus too. Like find what you do have a positive association with. You know, is it, hey, I committed to this and I actually set this money aside and I invested it in the market. Like gamify the actual behavior of investing. You know, hey, I saved this much money and I put it away. Like what are those positive behaviors that you associate with, you know, the emotional side and lock into those, you know, try to
Mm.
focus your attention there rather than being fearful of the market.
Yeah. That made me think of another, just another question. Is something that Josh said a minute ago. Like, does level of income at all like impact the decision of like how you should be investing? Like, it's like if you're like, here's what I'm thinking. You know what I mean? Like, if you're not at a certain level or not at a certain percentage of like what you're investing in retirement, what you're saving, like should you not consider something like trading at all? Or should you not consider single stocks at all if you're not at this income level or this percentage of, you know, what's being invested for retirement? What's the take on that?
I guess I'll share again. Um, I, yeah, I mean, yes and no is kind of how I'll answer that. Um, yes, you should always invest something to build that muscle. No, you should not invest very much if your income is not at an appropriate level. Whatever that appropriate level is, and it will be wildly different depending on every individual because of demographic and all the nuances and moving pieces that go into somebody's financial life. So I don't even want to share a percent because that can be
It's
misleading.
hard.
But yeah, that's kind of. But then at the same, I mean, if it's $5, dude, like do something. I mean, just to start moving in that direction. I don't know. Is that right? Is that wrong? I don't know. Is it both?
I don't think there is a right or wrong.
I think you're investing in something either way. Like if you're not putting money away for later, you're going to McDonald's. You're putting it into something now.
There you go.
Um, I don't know. I saw a video this week just talking about compound interest and what that looks like over
Mhm.
time, and it's like, man, if you do the math, like $10 you spend today, what that would look like if you just track the market for in an index for 25, 30 years with compound interest, like that's that's a sizable lump sum. That's thousands of dollars there.
Mhm.
Um, so you are investing in something. Like you're investing in an experience now, and you're sacrificing kind of that later, and that is okay. That like I don't want to create fear around that. Just know that you're investing in something, and yeah, let that dictate your behavior. Let that influence kind of how you make decisions.
So, okay, so kinda along those lines, how do you talk to somebody to adjust their investment strategy? Whether, because like that's kind of the focus of our conversation tonight, whether it's mutual funds, indexes, or stocks, as their financial situation evolves over time. How do you kind of talk to somebody to adjust that strategy?
Yeah, I mean, like, if it's somebody like you who just, like, loves trading, single stocks because it's a fun hobby, then, you're probably never gonna change that. You're probably you might, but if it's something you stick with, then there's no harm if you've always got the disposable income to do it, whatever. For the average person that maybe is just, like, considering, their wanting to retire, they're not wanting to think a lot about money. I do think where your money is invested should change, over time. Right now, one of the reasons why I'm willing, if it kind of feels silly to call a mutual fund a risky investment because I don't really think it's a risky investment. But I guess if you were putting it on a scale of risk, it's probably riskier than an index fund. Part of the reason why I'm more open to that is because I'm 25. Like I'm hoping that I have 40 years until retirement, or more. And so I'm open for the long game. But if I was 65, I'm probably not putting any of my money in single stocks at all. I'm probably done. Like we're taking all my money out of single stocks. We're putting it
Well, and
all
hopefully
in.
by that point you have enough of a cushion that you're like, well,
Exactly.
I've spent the last 40 years doing the wise thing so that I am where I am and I don't have to think about that anymore.
Yeah. So I think it definitely changes, and I think it should change where your money is invested. Should change. You should, as a general rule of thumb, you take less risk with your money as you get closer to retirement and as you get closer to needing that money.
Hmm. Yeah.
Yeah, and I think beyond age, I mean, it's like, man, do you have more to lose or more to win? I think if you're dealing with a lot of capital, you probably want less exposure to risk. There's a reason why, maybe some big hedge funds or these things, they're not just picking like one or two stocks or they're not day trading. Like if you're sitting on a lump sum of capital, you have more to lose and you have more to gain. Getting an
Mhm.
extra, you know, 6, 7, 8% this month is not going to change your life as much as losing everything in a single trade. You know,
Mm.
so I think beyond age, yeah. I'm sorry, Josh.
Yeah,
No,
you're bringing up wounds, okay, that I'm
yeah,
still
no,
working through.
yeah. We'll move on,
Offline, we'll talk in detail if you want.
but yeah, just think about like, is the swing worth taking? Is a swing worth taking? Even if I hit a home run, um, is that going to change my life as much as striking out here is? And really evaluate that,
That's
I would
good.
say.
Mhm.
That's
Yeah.
good. Last question.
Closing
Well,
thoughts. Okay,
yeah,
last question. Go ahead.
last question. Just one practical step. I mean, make it one sentence. You know what I mean? Practical
Yeah.
step that somebody listening to this that's saying, "Hey, I want to maybe learn a little bit more about one of these things. I want to start taking better control of my finances by using one of these vehicles of investment." What would you say? One sentence.
How about 2 words? Educate yourself. YouTube is free.
I'll go 2-word answer too. Try it. Try it. try some different vehicles and see which one you resonate most with. And that might not be the one that is, best for you or best performance wise, but it'll get you started.
Here's one more 2-word answer. Just start somewhere. That'll be mine.
There you go.
Start somewhere.
So, Dylan, where can people find us? Where can people find Campbell?
Yeah, we're obviously here on YouTube, Spotify, and TikTok. That's where we're spending most of our time. We're on the other socials. You can find us on the other ones, but that's where we're spending most of our time. Campbell's one of our good friends. He's got a lot of cool things he's putting into work with Faith Fueled Sales. I'm gonna let him, just take a few seconds to share a little bit about that and where people could find it if they want to learn about that.
Yeah, I appreciate it. These guys are awesome. So go check out their stuff first and give them a follow and show some support. But if you want to learn, man, how to sell and do that in a community that, of people that are not compromising their values to do so, that's been my personal journey, and I want to empower other people in that. So we're small but mighty right now, but that's what we're going for. So anyway, check us out, Faith Fueled Sales. Really all socials and platforms. We're there somewhere. You don't have to look too hard to find us. So check it out.
We'll put a link in the
Awesome.
description.
Awesome. Love it. Awesome. Thanks, team. Thank you, Campbell. Appreciate your time, and we'll see you
thanks,
next
guys.
week.